Hello and welcome to the Capital Market. I am Edidi Ongiwang, where reactions continue to trail Nigeria's 2019 GDP numbers released by the National Bureau of Statistics on Monday. This time, it's coming from the Chief Executive Officer of the Nigerian Stock Exchange, Oscar Onyema, who says the country has its work cut out in order to achieve economic growth over 8% and single-digit inflation rate.
I must balance the IMF's comments with Nigeria's GDP numbers, which were released just this morning by the National Bureau of Statistics, reporting a Q4 2019 GDP growth performance of 2.55%, which is the highest quarterly growth since the recession in 2016, culminating in a full year 2019 growth rate of 2.27%. Putting this side by side, annual population growth rate of about 3%, the message still remains that we have work cut out for us as a nation, and the economy must grow at over 8 to 10% and control inflation to single-digit rates if we must enjoy robust per capita income growth. This is not a short-term task, but a long-term one, and we look forward to the sequel to the Economic Recovery and Growth Plan, the ERGP, to address this existential economic threat of a sustained slow growth. Suffice it to say that the government's fiscal and monetary reforms over the past 2 months have shown some intent at tackling the nation's challenges. In particular, we note the clauses in the Finance Act 2019 and how they better recognize the income-generating status of micro, small, and medium-scale enterprises, thereby taxing them, reducing taxes and indeed exempting them in some of the tax reforms that have been recently announced. Honorable Minister, over the past 2 months, also, the Nigerian Stock Exchange has been in the news as we turn a page in the history of the 60-year-old institution into a technologically and more commercially driven multi-asset class exchange hub ready to support Africa's largest economy into the era of the fourth industrial revolution. First, the NSE All Share Index outperformed exchanges globally with a return of about 7.5% year-to-date in January 2020. I must say that has now slowed down to about 2% as of last Friday. Second, we recently launched the NSE Growth Board to encourage companies, particularly SMEs, with high growth potential to seize the opportunity of raising long-term capital and promote liquidity in the trading of their shares. The board presents an avenue for these companies in their growth phase to leverage the NSE's platform and varied products and services to achieve their long-term business objectives. The board is designed to offer relaxed entry criteria as well as less stringent ongoing listing requirements and allow for greater accessibility to capital flows, global visibility, and credibility through corporate disclosures. Third, our journey to becoming a demutualized entity is in its final stages with a court-ordered meeting and an extraordinary general meeting slated for March 2020. As we transform operationally and institutionally, we are confident in becoming even better positioned to support the government in raising the right-sized and long-term developmental capital required to financing its economic objectives. Apart from supporting capital raising efforts of government through innovative products such as the Green Bond, and it is important to mention that Nigeria is the first country in Africa to issue a sovereign green bond that is certified. The NSC has also developed a framework that supports the issuance, listing, and trading of tax credits in order to complement the road infrastructure development and refurbishment investment scheme. We are equally positioned to unlock significant investment value for the nation through the listing of public utilities and state-owned enterprises, as well as promote the knowledge economy in terms of public sector capacity building through a technology-based learning management system, the NSC X Academy. Finally, through our government relations activities, we will continue to partner and engage with the government to advocate for policies that deliver an enabling business environment for the Nigerian capital market and the economy at large.
Developing the Nigerian capital market was top on the agenda of the Minister of Finance, Budget and National Planning, Zainab Ahmed's visit to Lagos this week. The minister reiterates the federal government's plan to introduce more tax incentives that will boost investment in Nigeria. While speaking at her first official visit to the Nigerian Stock Exchange, Mrs. Ahmed highlighted some of the capital market reforms and tax incentives enacted in the Finance Act 2019. Let's take a listen.
The Finance Act 2019 for real estate investment trusts, which you normally call the REITs. The REITs are special purpose vehicles that serve as holding entities for investors' interest in large commercial or residential real estate projects. REITs may take the form of companies or trusts in many jurisdictions. In Nigeria, however, the Securities and Exchange Commission regulates trust REITs and the unit trusts of each REIT and corporate, as well as corporate equity REITs. So SEC has this responsibility, and what we are doing in the provisions we made in the Finance Act is to be able to expand the opportunities in the market. Finance Act 2019 also eliminates the multiple corporate taxation under the excess dividend tax rule, but only for approved REITs duly regulated by SEC. As your financial advisors and tax consultants will undoubtedly have reviewed the Finance Act and unbundle the technical details of the reforms that is provided in the Act, we expect to see a significant increase in REITs listings in the Nigerian Stock Exchange, a higher level of flows of debt and equity capital being deployed in large-scale commercial transactions, as well as in residential and other real estate projects nationwide. We expect to see the attendant multiplier effect of job creation, wealth aggregation, as well as deepening the capital markets and increase socio-economic development. Let me also touch on another aspect of the Finance Act 2019 that provides incentives for regulated securities lending. The Finance Act also provides targeted tax incentives for SEC-regulated securities lending transactions, which are often called stock loans. A stock loan occurs when a long-term holder, for example, a pension fund or other institutional investors of a share, creates a secondary income stream for itself by lending its own shares for a short period to brokers who are building portfolios for shares for their clients. As shares are fungible, the client can return an equivalent share of the same company through its broker to the lender at the end of the stock term. To guarantee that the shares will be returned at the end of the stock term, pension funds and long-term institutional investors require brokers and their clients to put up cash collateral that is equivalent to the value of the share units that have been lent. At the end of the stock loan, the brokers return the lent shares from its clients to the pension fund or the long-term investor, and also the lender returns the cash collateral to the client through its broker. Now that our tax laws are consistent with SEC's regulations for securities lending transactions, we expect to see increased growth in secondary and tertiary trading in the shares of the Nigerian Stock Exchange. Your brokers and tax advisors may provide you with further technical details and advice when planning your prospective securities lending transactions. We will also provide greater information, more analysis, and technical support on these issues during the forthcoming stakeholder implementation workshops, which we have designed to start happening in the next couple of weeks. I have highlighted a few of the targeted tax incentives in the Finance Act of 2019 for the Nigerian capital market. And as you may clearly discern, the tax incentive for SEC-regulated REITs only provide benefits after the investors have, 1, built their malls, their hotels, their airports, seaports, or logistics parks, thereby creating jobs and fostering economic development. And that is also after, 2, they have earned and distributed dividends from their rents and profits to investors. Similarly, the counterparties in the SEC-regulated securities lending transaction only obtain the tax exemptions after they have successfully completed their stock loans and repurchases without any insolvency events. Going forward, we are committed to moving away from the blunt and expensive fiscal incentives like import duty waivers, lengthy tax holidays that reward investors merely for an intention to invest. Rather, we will design and implement targeted and more efficient fiscal incentives that reward investors after they have kept their promises to invest, after they have created jobs, after they have deepened our capital market, and also after they have abided by the applicable rules and regulations.
Meantime, the head of investment research at AfriInvest, Biodun Keripe, reacts to some of the issues raised by the finance minister during her visit to the Nigerian Stock Exchange. Let's have a listen.
Given the fact that the capital market over the last 2, 3, even 4, 5 years has not really delivered superior returns, which would have compensated investors for whatever transaction charges they possibly suffer, whatever waiting period they've had to hold on to their investment, you know. But looking at this cost from a percentage or relative perspective, all in all, I think that cost is probably less than 5%. When you're doing your buy and your sell put together, the total cost is less than 5%. I mean, if you compare that with what is obtainable across global exchanges, be it in SSA region and other advanced market, you see that these fees are relatively competitive, and while there is room really for the NSC, the SEC, and the CSCS to sort of possibly tweak, lower the cost of transacting or trading on the exchange, we should also give consideration to the fact that the NSE itself is nearing its full demutualization stage, which means on its own is becoming a single operating entity, which then means it has to start reporting profit and losses. It has shareholders that must report its operating performance too. So on one hand, it's also a business, and it also seeks to maintain its operating cost. In terms of percentage of employee it has to the Nigerian population, I can't put a figure to it because I don't know.
You're not a regulator.
But I know it's contributing its fair share to employment, to the labor market, basically. So it sort of still needs to keep its balance sheet strong and profitable. So there definitely just have to be a middle ground where we need to look for ways of encouraging local investors, encouraging local institutional investors to really come into the market and fill up the gap, really. I believe that there are rooms for improvement.
So let me just ask you this. What sort of incentives will then match this restructuring process or demutualization of the stock exchange eventually? Because I know that the securities lending is something that it looks like they're really ready to grab now and start, enforcing in the system.
It's tough for me to think of incentives from an NSE perspective right now. It's really tough for me to think of an incentive from them. I mean, they're very bullish on on letting securities lending fly. I mean, it's actually operational, or it's in operation, just that the volumes are quite negligible. They're not so massive. So you're just looking for how to scale it up. And I think the incentives from the Finance Act allows for operators to then come in and we can then be able to see this scaling, this upward scaling that the NSE looks forward to.